right, Bill, I wanted to get your take here on the fallout from the Fed. A little bit more hawkish than maybe the market wanted at this point, but I don't think they've changed their narrative or tone over the last several meetings. I mean, Fed Chair Powell was a little bit more dovish in December, but he's been basically telling you that, hey, the economy's doing great at these restrictive levels. So maybe the market, you should reassess your outlook for rate cuts as early as March.
Yeah, I mean, looking in hindsight, that December meeting, he did take a bit more dovish tone than maybe he even wanted to. And but it did get the message across that they were transitioning away from that hawkish bias. And they officially removed that hawkish bias yesterday, but that was really widely expected already. So we've called this in years recent, we call it the Jekyll and Hyde effect, where they sort of use this balancing effect to really kind of keep investors, market participants on their toes. And yeah, I think, again, in hindsight, the way the market interpreted December and started pricing in 7 cuts immediately, that was a little overzealous for the Fed. So they wanted to rein that in. And I think the market was really in line with everything that had said, even though the statement was a bit more hawkish than expected, until he dropped the bomb on really pushing out those rate cuts from March out to the spring. And if you're an investor, this really doesn't change much. If you're an investor, yeah, March moves to May. We're heading into a little bit of a seasonally bearish type of time of year, just quietly bearish, not even over bearish here. But if you're a trader, there's obviously opportunity that arises from this.
Yeah, the optimism in the equity markets going into this, the wealth effect that it's created, some of the data that we've gotten, whether it's consumer sentiment, consumer confidence numbers on the rise, wages keeping up with inflation at this point, jobs market robust. I mean, he kind of laid out the plan, didn't he, Bill, that, hey, don't get over your skis at this point. And I think maybe they thought the equity market is at this point. And investors should take heed of that, because if you look at the valuation of the S&P 500, it's getting stretched here. Yeah,
I mean, talking about the data first, it's really waffled around. I mean, we haven't seen any decisively break into the negative territory. We haven't seen any, really. I mean, obviously, jobs have remained pretty steady higher than expected. And, I think if you look at more recently, we saw the jobless claims sort of bounce back up. Looking back 2 weeks ago, I was saying that jobless claims number that came in at 187, I think it was, that's going to be a low print for months to come. We look at the ECI number for Q4 that came out, the Employment Cost Index yesterday, ahead of the Fed. That came in a little slightly lower than expected, 90 basis points versus 1%. So we could start to see this evolve, and maybe that's really what Fed Chair Powell was acknowledging yesterday. We're starting to see maybe the labor market cool off a bit, and they need a little more time to interpret the data that comes. We see non-farm payroll coming Friday. ADP payrolls yesterday. That, I mean, really has done its own number relative to non-farm payroll. They haven't been hand in hand, and that number came in. It's missed, I think, 5 of the last 6 months. Mm-hmm. So I think we're maybe starting to see a little bit of a rollover in the labor market potentially, and that's what the Fed wants to see. But here's the deal: is inflation. We're starting to see disinflation. Inflation's really coming down. Look at PCE numbers getting down to a 2 handle. Look at the rolling 6 months. It's like something 1.8. The Fed has accomplished their goal with inflation. And, you hear a lot of people talking about, they shouldn't let up now. I mean, really, the people that are saying that are people that want to see pain in the market. If you take a step back, if you want to see a recession, you keep real rates hanging around 2%. The highest level, this is 10-year real rates, when you have the 10-year yield minus inflation, highest level since 2007, right before the great financial crisis. If you want a recession, you keep real rates here. So ultimately, the reality is they want to cut rates. They're just waiting for a little more evidence here.
I agree with that. I think that was the consensus among the Fed. Even in the voters, they expect to cut rates. The market is getting a little bit ahead of itself at this point. But when you look at the equity market and the optimism that's there, breaking over the 4,900 level for the S&P 500, it seemed like it was tractor beam into 5,000. I think that's one of the concerns for the Fed at this point, this push into risk assets where, hey, maybe earnings season's going okay. It's not blowout and spectacular, but the bar's really high here, Bill. Is there still room to the upside for the S&P 500? Because I think that's what everybody's waiting for, that pullback so they can get back in. But if we have that pullback, maybe that's due to the fact that, hey, maybe earnings aren't as great. Maybe the multiple on the S&P 500 shouldn't be this high.
Yeah, that's a great question. I do think that a consolidation here is very, very healthy. I mean, if you look at an election year, the second half of February tends to be a little bit of a pullback. Coming out of some of the exuberance in January traditionally can bring a little bit of a pullback in February. It's, I think, maybe the second worst month seasonally coming into February. So, yeah, I think a consolidation here would be healthy. Holding ground would be healthy. At the end of the day, what we saw come out from AMD, NVIDIA, a lot of the AI names that really rallied strongly and led this market higher is we already had the earnings beats. I mean, we really priced that in already. So I look back at NVIDIA in August of last year. It was a great number, but it didn't trade higher, and it went sideways, didn't do anything for 6 months. And then we finally broke out in January. I think we could be going into a period like that right now where we have solid reports. I mean, Microsoft and Alphabet. Microsoft is a little underwhelming, but Alphabet wasn't good. I wouldn't be surprised to see 3 decent reports today between Apple, Amazon, and Meta. But do they actually trade much higher? I have a little bit higher hopes for Amazon at this point, but what's going to lead the market higher? And that's the real question here, is if the market already priced in the stronger than expected results, then it would make sense to see us consolidate. We would have to see some of the cyclicals really wake up. And before yesterday, we had some of the financials starting to do some really good things. Bank of America was trading really well. The Russell 2000 was actually trading higher through the middle of the session. It hasn't been able. Small caps, they would open higher from an overnight trade, and they get slammed. We actually traded higher earlier in the week during the session. So there are some parts of the market. Industrials are doing very well. I mean, look at Caterpillar hitting 52-week highs. United Rentals, a blowout report. I mean, we got some really great things taking place within the market, but we're going to have new leadership to take us higher right here, right now.
Yeah, that's definitely true there. And I like your thought process because we've been talking about that on other shows, that high bar, low bar during earnings season. Maybe a little bit of profit taking on some of these companies that had rallied. AMD is a perfect example. Google Alphabet also, which just hit all-time highs. Meta Platforms just off all-time highs going into the report. Amazon elevated at this point too, going into the report. So high bar set here. All right, great breakdown for us, Bill. Appreciate it. Have a great day.
Thank you. You too.
All right.